So what is going on today, guys? Today we're going to be talking about mortgages. All right, so let's get started. I'm sure everyone knows what a mortgage is and how it works, but if not, a quick rundown. You're taking money from a lender or from a bank to purchase an item, whether it's a car, a house, whatever it's going to be. You're pretty much borrowing money from somebody to make this purchase because either you don't want to put down the full amount or you don't have the full amount. So you put down a little bit and tell them, you know what, you can guarantee the rest of this loan that I'll make sure I pay it back. If not, it'll hurt my credit, because they do have the income to make that happen. So what you do is you end up paying that money back, but you pay it back with interest. All right, now we're caught up. So number two, now we're gonna be looking at positions on mortgages. So mortgages come in different positions. When you go to a bank and you end up getting a house, that's the first mortgage on a property, right? So it's in first position. So for some reason, the property is doing well, but you're doing poor in your finances. You can't keep up with your mortgage payments, and you end up defaulting on the property itself. So what happens then? So what happens is that the bank gives you a notice that you have to make an X amount of dollars for a payment in order to recover your previous, month, 2 months, 3 months, whatever it is, worth of mortgage payments. Plus, you're gonna have a penalty on that for sure. So if you end up paying that money back to the bank and you end up getting back in good standing with them, you can continue holding the property. But let's say, for example, you didn't end up paying the bank back. Then what would happen? What would happen is that your property would enter into default, right? So if the bank gives you the notice, you say, you know what, I tried, I couldn't do it. The bank can legally take that property back from you, foreclose on the property, and then end up selling it off into the open market, right? So what happens is that because the property is under the first mortgage as a bank, this is the only mortgage that's on the property right now. That means that the bank, if under any default, has full right to take the asset back and then sell it for whatever price it's going to sell for. And then whatever's left at the end of the day, let's say you have the property for $1 million, you have a mortgage of $700,000, and the property sells for $900,000. What's gonna happen is that this bank's gonna pay back their own loan of $700,000 and then keep the excess of $200,000. That's only if you have a first mortgage on the property. But now what happens if you have, a second mortgage, a third mortgage, whatever, you have businesses, you have your children for school, you need to finance some money out of the property in order to make these investments, or in order to make some money move around for you. So what happens is that if, let's say, for example, you're in the same scenario, the bank foreclosed on the property because you couldn't pay the rent, and you have the same scenario again, property's worth $1 million, you have $700,000 of debt with the first bank, with the bank, you have $700,000 worth of debt as your mortgage, plus you have $50,000 for a car loan, and then you have $100,000 for education, let's say. Right, so what's going to happen is that if the bank sells for $900,000 as it did last time, it's going to pay off its own $700,000, then it's going to give $50,000 to the second mortgage, then the third mortgage is going to come in line and ask for the remaining $100,000. So based off the position that the mortgages are set in, after the sale of an asset, it goes down a tier system. The first is always priority. You have to pay off the first one, or however much you can off the sale, pay it off. Like say, for example, if the property only sold for $500,000 and the mortgage on it was $700,000, you'd only pay off $500,000, and the other $200,000 would count as a loss towards the bank, right? Obviously, because you don't have any other excess in money, the car loan plus the education fund they're not going to get any money at all, right? So depending on what position you are in this sort of mortgage ladder, you're going to either end up receiving the funds that you were due, some of them that you were due, or none of them that were due, right? Simply because there is a priority. There's sort of a hierarchy in the system here, where if you were to put the first mortgage on a property, you would have the highest priority. And this is primarily why, if you were to do some sort of purchase on a property and you say, you know what, you can't get the mortgage from the bank because you don't qualify for your income or for your credit score or whatever it might be, what would end up happening is that most of the times for investment properties, you would end up going to the seller and asking them for a vendor take back. And that's going to be coming on a different video, but pretty much the vendor take back is the seller ends up acting as a bank and the buyer ends up giving them the mortgage payments. It's usually for a shorter period of time, maybe about a year, 2 years, 5 years tops. And then after that, that mortgage with the seller balloons. So what that pretty much means is that you have to owe them back the total of the remaining mortgage that you owe them in one go. Right? So there's no more extensions on that. So this is why investors like to be at the top of the rank. They want to invest in the property. They want to be, position 1, position 2, that's it. They don't want to go to position 3, 4, 5, 6 because that ends up becoming more risky, especially if someone's taking on so much debt on a property that they're in the 4th or 5th position. That in itself would be a red flag. The next thing would be if they aren't able to hold it and the asset needs to be sold at a loss. Position 3, 4, 5 most likely aren't getting their money. Position 2 won't be getting its money either if it's sold at a loss compared to what it was bought for. So whenever you look into getting into these sorts of investments, always try to look into seeing, what position do I want to be in? You obviously want to be primary, but most of the times you can't be primary unless you are the vendor in the vendor take back loan. So the next time you look into these sorts of properties that are out there, always look to see if you have to assume the debt on the property, right? Because the interest rates are good on it. How many other loans are left, right? Because if you have to close on the property, you have to pay everybody else out, right? Because that just shows you the debt ratio that you have in the property, and that'll give you a better picture of if this property is going to make financial sense for your investment or not. So if you have any questions, feel free to give me a shout anytime. Message me, leave a comment, like, subscribe, and I'll be happy to get to you in the next video. Thanks, take care.